Well, hello, everyone. Thank you for attending this afternoon's webinar. Uh, my name is Bob Fedor from Cleveland Score, and our guest speaker today and presenter is Liz Patrick, the Chief Lending Officer at Comstar Credit Union in Elyria, Ohio. Um, we'll wait a few minutes for you all to check in, and then I'll start out with some preliminary slides on Score, and hopefully many of you have seen this, but I'll go through it quickly. I'd also like to comment that Comstar Credit Union is a sponsor of Score for many years, a contributor in terms of the workshop series, presenting this Behind the Lending Curtain part 1 and 2 at least twice a year. And it's contributed to educating hundreds of our clients on the secrets behind the curtain. And we think it's a unique presentation and very valuable for all of you. And thank you for attending. Uh, we seem to be getting a lot of people coming in right now, and maybe it's best if I just start the general Score presentation and then turn it over to Liz. For those who don't know about Score, it's the largest network of free volunteer small business mentors in the nation. No matter what stage your business is, we have a mentor for you. And by the way, that includes nonprofits in addition to for-profits. You could easily request a mentor to help you start, grow, or transition your business today. Our mission is to foster vibrant small business communities through mentoring and education, such as this workshop. Try to give every person the support they need to thrive. Small business drives our national economy through business formation, job creation, and wealth building. They're critical to vibrant communities in Ohio. Our volunteers give freely of their time, energy, and knowledge to help others. Here's some data. A couple of years ago, we haven't got last year's data yet, but we started over 31,000 businesses, created over 120,000 jobs in the non-owner category, and over 152,000 total jobs created. We have approximately 10,000 volunteers throughout the country. In northeastern Ohio, in the Cleveland area, we have approximately 100. And if you include Akron and Canton and nearby areas, we're probably over 200. Our client base, about 65% women, that may surprise you, 46% minorities, 13% people with disability, and about 10% veterans. We are for all, whether it's Black entrepreneurs, Hispanic, women, veterans, any category. As long as you're legal in the United States, we'll give you free and unlimited mentorship. Now, one of the critical things is we do have a code of ethics, which we signed every year. In fact, we just went through this process this month. All volunteers need to agree and sign that we would not make money in any way from our clients. That's you folks. We will not use your database for any commercial reason, and all your information that you provide us is confidential and protected by the U.S. government. As an example of success, you go to our website in score.org, our national or Cleveland website, you'll find many examples of our success stories. Here's one. Health Sitter Solutions is a typical minority success. All our services are free because our work is supported by the SBA and generous sponsors such as Comstar, and our volunteers who are able to deliver our services at no charge. And if you want to avail yourself of a mentor or our other workshops, please go to our website, www.score.org, or follow this code. And you'll find a mentor. Or if you were interested in volunteer, that'd be great too. Now, enough of the preliminaries. I would love to be able to turn this over to Liz and let her give her presentation. Liz, I have to stop share here?
Correct. Yep.
Okay, and you got it.
Excellent. Thank you so much. I appreciate it. Thank you very much for those kind words as well. I'm going to share my screen here real quick. It'll just be one moment.
There we go.
And can you see that?
I can.
Okay, excellent. Perfect. So I just want to say good afternoon, everyone, and thank you for joining Behind the Lighting Curtain Part 1. I just want to let you know there will be a Part 2 held on September 9th at the same time. But I just wanted to mention that we're really excited to give you an inside look on how lenders and financial institutions review your business loan requests. Fun fact about today, it's actually National Financial Awareness Day. So I think that's really cool, considering that we are all in this webinar together. And it's also another fun fact, it is National Creamsicle Day, which I think is pretty great as well. So hopefully you can enjoy a creamsicle later. And during this webinar, I am going to ask, if you do have any questions, feel free to put it in the chat. But I will get to those at the end of this presentation. But thank you.
And Liz, I'll monitor the chat box. If there's something to interrupt with, I'll do that.
Perfect. Thank you so much. I appreciate that. All right. So again, as this first slide that we're looking at, Behind the Lending Curtain, Part 1 is Get to Yes. Essentially, it's an ideology that our credit union has adopted to do what we can to offer our members options to get to loan funding. So this is going to be an overview of what lenders are considering when you as a small business owner submits your loan application packet and why you won't have an answer tomorrow. A little bit about me. I know Bob gave a really good speech about me, and I appreciate that, and Comstar Credit Union. So my name is Liz Patrick. I actually recently was promoted to CLO at Community Star Credit Union in Elyria. I oversee lending, including business lending. I've been actually with Comstar Credit Union for over 14 years. And since 2017, I've underwritten numerous business loans and have worked as a commercial loan officer as well. The credit union and I are committed to helping businesses achieve their financial goals. And I hope you learned something as well in both of these sessions. A little fun fact about me, I do enjoy kayaking. I kind of started kayaking last year and I just fell in love with it. I'm not the best, but I think it's a really good exercise. And then I do have a few reptiles. When I say a few, maybe a few hundred. My husband and I, as a side hustle, we have snakes that we raise up and we also breed. We do nothing venomous and everything's legal, I promise, but we do have a small business there as well with the snakes and everything like that. So, but enough about myself. Let's go to the meat of exactly what this presentation is about. So I first want to say congratulations on taking the steps to owning your own business. Whether your business is a sole proprietorship, an LLC, an S Corp, or a C Corp, a partnership, a 501c3. It's important to make sure that you're registered with the state of Ohio, and if applicable, acquire an EIN with the IRS. There are multiple business structures that will need different paperwork as well, such as the operating agreement or an articles of incorporation. So it's important to also develop a business plan for the future of your business. So during these two sessions, we're going to discuss the matrix, which essentially is the risk score and the calculation of risk. You'll see that there are going to be two different matrices, and I'll explain that a little bit later. In addition to, there's the risk barrels. And again, I'll show you a little bit of a good visual representation of risk and those mitigating factors. Loan structures and commitments, defining the terms of the loan. Is it going to be a balloon loan? Is it going to be fully amortizing? Is it going to be a fixed rate or a variable rate? Are we keeping it in-house as a conventional loan, or is it going to go SBA? And with the commitments, it's the business commitment letter as well that you'll sign upon approval. I like to mention the dream killer, which I'll go a little bit more into detail later as well, and the committee. What yes for no, I'm sorry, yes for now versus no for now means, and funding, what to expect and what is expected of you at loan closing, and life after funding. After the loan is booked, it will still be reviewed periodically, and documentation may need to be requested for that as well. So in the beginning, we're going to start with a quick refresher. So it's important to understand that each financial institution is a little different, but most of them have the same consistent standards. So I think the main thing here is the banking relationship. Relationships absolutely matter. So it's important to identify and know who your go-to loan officer is and banker is. They support you and your loan requests. Having and building that relationship is really important. They're the ones that go up to bat for you. They're the liaison between underwriting and your request as well. And it's really important to have that strong business lender. I do want to mention SCORE. And actually, before I mention SCORE, the banking, when I go back to the banking relationship, there was one time I had worked with a small business owner, and he was actually a chemist. That was his day job at the time. And his specialty with his business was actually brewing his own beer. And I thought that was really cool. And we were actually able to help him construct a brewery. So I thought that was really fun. But it was interesting because I actually worked as the loan officer on that deal. And every time we would talk, I mean, his eyes would light up. And he was just so excited and passionate about what he did. And I could tell. And that really helped with, that building that banking relationship. He would mention like chemical equations on how to create the beer and stuff like that and produce it above me because I only know math, not necessarily chemistry. But I could tell that he was really passionate about what he did. And he also did a tremendous amount of research on the craft of brewing. And I could definitely tell that while reviewing that business plan. And that's where SCORE and the Small Business Development Center, SBDC, comes into play here as well. Both are an excellent resource for your business, as many of you in this webinar can attest to. It's a free service to you, and the volunteers are so passionate about the success of small businesses, they literally invest the time in you. So with both programs, they can assist with business plan writing, which provides a detailed narrative of a business's goals and management history. It can include a SWOT analysis, strengths, weaknesses, opportunities, and threats, a market analysis, and an analyze of your competitors as well. In addition, the business plan for a startup company generally requires to have 2 to 3 years of financial projections. Personally, I can tell when reviewing a business plan from a business owner that was mentored through SCORE because it's always very, very thorough, very well prepared, and very well researched as well. And I do appreciate that. All those documents. So during this loan package process, the lender is going to ask you for multiple documents, including but not limited to the application package, which includes obviously the application, a personal financial statement, which essentially is a balance sheet of the guarantor's personal assets and liabilities, a business debt schedule, if applicable. Not all these are going to be applicable, but if it's for an already established business, some of these documents will be. A 4506C, which is essentially ordering, your tax transcript, your tax return transcript, 3 years of tax returns, financial statements, W-2s, pay stubs, 3 months of bank statements, and the business plan, just to name a few. There could be more, but that's just the general standard. And then even more documents for SBA. Not many more. They've actually streamlined it quite a bit, which is really great for the lender and the borrower to gain access to capital sooner. So I think that's really important too. And again, like I said, as a reminder, even though I'm saying these are the documents that we need, each financial institution is a little different, but they all have the same consistent standards. It's important to remember that I'm personally responsible and it is reportable. So while personally responsible for the loan, and it is reportable. Filing an LLC or S corp may protect you from the operational liability. However, it does not protect you when standing behind that loan request. For break even is really 25 cents short. When you think of break even, you think of like one to one, what's ever coming in and what's ever going out. Whereas zero, that's what's break even. On a lender standpoint, we really want to see above break even. So to put that into a different term, what we want to see when we're reviewing your financials is for every $1.25 coming in, $1 or less would need to be going out for a small business to be viable. That's where most lenders are comfortable with when lending to a small business. Regarding the first money in is the last money out. Generally, first money essentially are the investors, including yourself as the owner of the business who invested in that capital in business at inception. So these are generally the last to be paid as opposed to a lender. These investors generally take the most risk because they're the last to be paid. I love paying my taxes. I know you guys all love hearing that. So what that means is you want to be comfortable. I know there are times where, you don't want to, it's good to write off, everything. And, you might have a really good accountant that writes things off to reduce your, business's liability. However, it doesn't necessarily look good on a loan application standpoint because we want to show repayment ability. So if you're showing all these losses that we can't necessarily add back in, that could affect and determine, whether or not we could proceed with that loan. It's also important to note that, the non-cash items such as depreciation, amortization, and interest expense are added back since they don't affect cash flow. Going back to your accountant, they know what DSCR means. So DSCR is an acronym for debt service coverage ratio. And debt service coverage ratio, there's two types. There's one that's transactional, and there's one called global. And what that is lenders that when we look at transactional debt service coverage ratio, this is solely based off of the business income and the expenses and debts of the business only. An example would be a real estate holding company, which owns a commercial property and rents it to another business, such as like a retail store or something like that. The real estate holdings income is the rent collected from the retail store, but the expense would be just those types of the building, such as taxes, maintenance and repairs, insurance. So simply put, if rental income is $1,250 a month, the expenses should not exceed $1,000 per month to be viable and to maintain that 1.25 to 1 ratio that we look at.
Liz, there's a question.
Yeah.
Are your processes any different for nonprofits?
That is a good question. So it can be a little different, and but it's not completely different. I mean, the loan application process itself would be the same way. Generally, though, you don't have to pay the IRS. So I know we would request just financials from either your accountant or, member prepared, borrower prepared financial statements. But everything else is generally the same. Really good question. Did that answer it? I just want to make sure.
Yes.
Okay, perfect. Thank you. Thank you. So I also want to mention global debt service coverage ratio. That includes income, debts, and liabilities from the business, the guarantors, which are generally the owners or anyone that owns over 20% of the business, and other business affiliates that you might have 20% or more ownership in. And that's where it goes to the next bullet, is that owners and principals exist at 20%. It's also important to mention that lenders aren't investors, which goes back to the first money in, last money out idea. Lenders provide the capital to your business, in a form of a debt that must be paid back. So most often, obviously, generally with interest. So as an investor or the owner of your own business, I mean, would you pay more than is agreed if the business does well? I think most people wouldn't. Um, so one other thing to mention, transparency builds trust. So when you schedule a time, either in Zoom or in person, I've done both, to go over a loan package, it's important to be transparent as possible regarding your current and past financial situation for both the business and the guarantors personally. This transparency and honesty builds trust. And honestly, me as a commercial loan officer, I've also remained transparent about what I can offer and the next steps that is needed for the loan process. So the next slide, we're going to discuss the three-legged stool, which is essentially all the pieces needed to review your business loan application. So the first leg of the stool is the loan officer. So this is where the relationship, like I mentioned previously, and transparency is important. The loan officer goes to bat for you and is your liaison to the business lending committee and underwriting. So they'll fight for you and your loan request to the business committee, who generally does the overall approval. The loan officer prepares the loan presentation, which includes the 5 C's of credit, and this gets presented to actually the business loan committee. The 5 C's of credit include cash flow, which we discussed previously, transactional versus global debt service coverage ratio. Is a business viable? Can it repay that loan? Character, which falls back on transparency and trust, how you present yourself, the business and your reputation, and the borrower's willingness to repay. Capital, the third one, the money that you have personally invested in your business or to help grow for the operations of the business. It's important that cash is king. I think I was taught that in my first class in accounting, so I thought that that's very important. Collateral, the fourth one, understand this is not the first one of the 5 C's of credit. You might have collateral and it might be a low loan to value, but if you're unable to show repayment ability, that doesn't necessarily mean that the loan would be approved. Conditions, the last one. So lenders will conduct a SWOT analysis, identifying the strengths and weaknesses, opportunities, and threats, and also identify industry trends and regulations as well. They also defend their matrix score. So the lower the score, which I'll go a little bit deeper in later, is the less risk involved. And they advocate for borrower approval. So it's very important to have that really good relationship with your loan officer. So the business loan committee, the second leg of the stool, reviews the loan officer package in the presentation. They evaluate risk profiles, and that could just be based off of the type of business that you're in. They evaluate, the FI means financial institution concentration position. So we have specific limits of what we're allowed to lend money to, just to keep that diversified portfolio. So like if we have a lot into a specific NAICS code, such as like a restaurant or something like that, we may not be able to, if we exceed our concentration limits, we may not be able to proceed with it. The Biz Loan Committee also looks at whether it should go conventional or go through SBA, in-house, if we should do it in-house, or have a participation loan. Participation, it can, there's differing factors for that. So again, that could be because of our concentration position. We might have to participate a piece of that loan amount out to another credit union. It could be based off of the loan amount. I know each bank or financial institution has a different limit, but we do too. We have a set limit. So we may have to participate out a specific amount. You'd still pay, for the loan, just you'd pay one lender, but there would be multiple parties involved. And they also, once they review the presentation, they also provide conditions to offer back as well to the to the loan officer to present. And conditions could be anything from, hey, the borrower needs to pay off this credit card to get to the debt service coverage ratio we're looking at. Maybe they need to look at like closing out a specific item, or maybe, hey, I know you requested 100,000, but we can only offer 75,000. Or we have to make sure that this loan is fully collateralized and there might be a shortfall or something like that. So the third leg of the stool, and I always laugh at this photo, is the dream colors, which is essentially underwriting. Um, and I laugh at that because I've underwritten business loans as well. But how, and that's just a accurate representation of you as the borrower, is handing off your application to the dream killer. So underwriting how to get that name as a dream color. So I didn't work with this person specifically, but there was someone that we knew that worked as a commercial underwriter, and she also actually worked with SBDC. And more often than not, even though she was a commercial underwriter, she would decline or not recommend approval for a lot of the loans that went across her desk. So because she killed so many dreams, she literally had the nickname coined as the dream killer. So that's why that's there. But I'll go into a little bit more detail on that later on in this presentation. So I'm going to go back to the matrix. So this is just a score that we provide for the business. So each financial institution has its own way to evaluate and assign risk scores. I'm actually looking at mine right now. In ours scoring model, it does go from 1 to 10. Most financial institutions like to see 3 to 6 in that range. I have seen some matrix that have only go up to 8. And so they like to see, 2 to 4, 2 to 5 in that range. And just like golf, the lower the score, the better your scorecard, which equals lower cost of borrowing and a higher likelihood of approval. So we take into consideration, your debt service availability, the credit scores of the guarantors. So we do take that into consideration as well. Loan to value, are we at 80%? Are we a little bit higher? Where are we there? The type of collateral. So if it's owner occupied and owner owned, it's less riskier than a non-owner occupied. Or if it's secured by equipment or even unsecured, those are a little bit more risky. So that might have a higher score. And it does take an average of all these factors. Years in business takes into consideration, and I understand with startups it's a little different, so it doesn't have a lot of weight. But profitable years, debt service coverage, all that is very important. So we discussed previously a little bit about the risk mitigation barrel. And like I said, this is a fun visual representation of what that looks like. So it's essentially how lenders look at loan requests, which are either full of risk or less risky. So if you look on the first one, a barrel full of risk, we're looking at that top one that says debt service, and everything is really tight and at the top of the barrel. It's full. So when you look at debt service, global or even transactional, when you see that, it's like probably just at 1.25 to 1 or even less, which can be an indication of it being over leveraged. And so that's why it has that tighter line. Equity, loan to value on the collateral. So there's minimum equity or capital injected by the borrower. So the loan to value is going to be higher, which, like it could exceed 80%. Generally, that's the standard, is we don't really go above 80%. Conventionally, and loan. So because of those two items, the loan dollars is going to be higher. So that's the amount's higher because of those above factors. And so your score might be a little bit higher on the matrix for both underwriting and for the loan officer. And if we look at the empty barrel, excuse me, you can see that there's a little bit more space in between them. So you'll see the debt service coverage ratio is a little bit higher, maybe at 2 to 1, or exceeding that. There's more equity, so the borrower has more capital, more liquidity to put down, which means a lower LTV, which is less risky for the lender and for you, and a lower loan request, which mutually benefits the lender and the borrower, because it can help with your cash flow by having a lower dollar amount in monthly payment. So the SBA effect, essentially, is the SBA guarantee. It mitigates any of the risk. It doesn't mitigate all of it, but it does mitigate a good portion of it. It's a government-backed loan that protects the lender in the event of default. So essentially guarantees the portion of the loan. This provides access to more capital to more small businesses, especially when there is a collateral shortfall, as we see in the barrel full of risk, or a debt service coverage ratio shortfall that may not fit into that conventional loan model. So what I like about SBA is that it gives the lenders the opportunity to say yes to small businesses they may otherwise turn away, because most of that risk is covered. And I think that's really important. And I know people kind of get a little nervous when they hear the word SBA, but like I said, while there are still a lot of guidelines that you have to follow, they've definitely streamlined the process, so it doesn't take as long to get access to any sort of capital or loans as well. So again, back to underwriting. Your loan officer, this is again presenting your underwriting, your loan request packet. So what I like to discuss about underwriting, because like I said, I'm an underwriter as well, and as someone who has underwritten business loans, I have to say it's not always true. We're not always dream killers, I promise. We're just trying to find a balance that's mutually beneficial between the lender and the borrower, because we want to help you succeed as well. It is separate from a loan officer. Underwriting is an important piece of the business loan process and the three-legged stool. As a reminder, while financial institutions are different, they have the same consistent standards. So underwriters evaluate that loan application package and determine the risk and credit worthiness of the business and its principal owners. Underwriters are considered disinterested third parties as they review that loan objectively. This is the first time they're looking at it. It's already been through the committee. It's already been through the loan officer. This is the first time they're actually reviewing it. So even though it's taken a little bit of time to get through those two, now we're going to that third piece to it. They evaluate the business plan. They review the credit history of the borrowers and the guarantors. They conduct a financial analysis and confirm documents submitted are accurate as well, which is really important. They have their own credit risk matrix, which we discussed earlier, and we'll discuss a little bit further moving forward. And then they can determine the conditions and covenants of the loan upon approval. It's important to understand the lender and borrower safety. I kind of touched on that briefly. Is the loan mutually beneficial to both the borrower and the lender? Making sure that the credit union is within guidelines and that the borrower can afford payment structure is really what underwriting is looking at as well. And regulator function, very important. Underwriters ensures that the loans requests meet regulatory internal lending guidelines. The financial institution has examiners to review loans, and underwriting confirms guidelines are being met. And that's the main focus of what underwriting does while they're reviewing your loan application.
Liz, there is a question that sort of fits in here.
Okay,
So
great.
earlier in the presentation, you mentioned that LLCs are not fully protected. Does that apply to a single owner corporation?
Great question. That I'm trying to bear with me on wording that. So we would treat it the same. So while you do have your business and the EIN number, and that's the borrower, we also take into consideration the guarantor, the owner, as you being the 100% owner on it. You would be responsible for the loan, and yes, you would also not necessarily be fully protected on that way. Good question.
Okay, and there's another question, might as well take now. You mentioned SBA. How long, on the average, how long does it take to get a SBA loan approved?
Yeah, absolutely. So with SBA, they've kind of changed a little bit of their guidelines. So a lot of what they do actually, they go based off of our underwriting. So because of that, as long as we once the loan officer gets everything that they need from you, like all the documents that they need, and they do that presentation that they write up and submit it to SBA. It generally takes no longer than 2 business days to actually get an answer from them. It could be less. Um, and then after that, then we go on to the next steps of how do we get um, the third party work ordered, if we need to order an appraisal or title work or stuff like that. I mean, but for the SBA specifically, the approval, it's pretty quick now.
Great.
Good question. I appreciate that. So moving on for the underwriting piece, the good cop, bad cop routine. I love hearing that. Good cop is the loan officer. Bad cop is the, I don't want to call them bad cop, but they're the ones that are asking all the questions. So that's why you think that. So again, it's just your banker is your liaison at this point. So we discussed that previously. They're the ones going back for you and will fight for you and your loan request. So it's important, again, I can't stress it enough to have that strong business loan officer and that good relationship because they have a strong impact on your business as well. When you see this, it's like those documents are irrelevant because it's underwriting's first look. They might request documents that you might not think are relevant. They might be irrelevant to the process. However, it might be helpful on the underwriting standpoint that they need this information to mitigate the risk and to get that loan to approval. You might see it already gave you all those documents, and maybe that is the case. And they might ask for it again, and it could get a little bit frustrating, but the purpose of the underwriting is just to make sure that they have everything that they need to get to that approval and everything, matches, everything's accurate and compliant too. I already explained that. They might ask you questions and you'll explain something, and then they'll ask even more questions and ask for explanations on your explanations, but that's just to be expected. It's not uncommon if you're like, oh, I already talked to this person about this, and they just need to hear it and see it, and make sure they understood um, the whole deal. They don't necessarily see the passion that you have behind the business, but the loan officer does, and that's why they're there for you. So underwriting does have the power to say yes. So that's good. That's an approval. They have the power to say yes, but maybe include some sort of condition on the loan that we discussed earlier. And they also do have the power to not recommend, which I call knows evil friend, because they could say, hey, I don't recommend approval because of these items. It could be, um, due to credit history. It could be due to, collateral shortfall. There could be numerous reasons as to why it doesn't recommend, but that doesn't necessarily mean it's not going to be approved. I have actually been in a position where I was on the business loan committee. Another person had underwritten the loan, and they said not to recommend it, but given we had a good relationship with this business and we've worked with them in the past, we were able to get it to the approval. So I don't want to say that just because underwriting says no, it doesn't mean that it's going to be a no. So back to the matrix, the side-by-side. Again, the factors include debt service, credit scores they look at, loan to value, the range tolerance, business profitability history. Again, if it's a startup, we'll look at your pro forma and everything like that. We do check, past loan performance if you've had loans with us in the past, or obviously with your credit scores. And when we run credit, we'll see, your personal performance as well. And we also see, okay, SBA guarantee, okay, well, it helps mitigate that risk. So that score might actually be a little bit lower this time as we review it. So once underwriting gives the power to approve or yes to recommend, it goes back to the committee for final approval. I know it seems like a lot. That's why this just absolutely shows that why you don't get an answer the next day. We are really working really hard to review everything and try to get a clear understanding of exactly what you're looking to do for your business. So the committee vote. So the good side, yes for now. We like to hear that. Are there any conditions? I know we discussed it a couple times. Pay off and close some specific debts. Maybe you have to let the lender know of any new debts afterwards. Making sure that insurance is there, an assignment of rents and leases if needed, if there's a mortgage involved. Covenants, that's specifically written on the loan document, so that on the final loan documents that you'll sign, and you'll find that out in the next session. But it's, that it has to be followed. So if there's, you have to maintain a specific debt service coverage ratio. When we periodically review your loan, we want to make sure that you maintain those covenants. Costs, what are the costs involved? Is there going to be appraisal involved? Title work, what needs to be ordered? Is there the origination fee? Is there going to be an SBA guarantee fee? Those kind of items as well. And then the next step would be, do we need to create the commitment letter for the borrower to sign, which just literally explains what the terms we're willing to offer to you as a borrower. And I recommend that you really review that before signing it. And you're always able to check with your loan officer and ask any questions before signing it to see, okay, what exactly am I reading? What am I agreeing to? Just to make sure that both parties are aware of the next steps on the loan process. Once that commitment letter is signed, then third party work gets ordered, like if an appraisal is needed, title work, those underwriting factors. So if there were any additional items that underwriting had noticed that we might need to get, whether it be additional paperwork or like statements or something like that, then that's something that they'll review as well. We discussed a participation loan. If any participants need to be included in the loan, that's where we reach out to other credit unions to see if they're for their participation. In some cases, an environmental questionnaire isn't sufficient, especially for commercial property. We may have to do something more like a transactional screening, or maybe even a phase 1 or phase 2. So we'll have to get that order. That takes about 2 to 3 weeks. And then a site visit. Is it required? Sometimes the appraisal is sufficient for the site visit, but sometimes the loan officer will go visit the site as well, just to make sure that it's there and in a good condition and sound condition as well. If it's a no for now, the factors could be based off of risk score. Maybe you fall like in a 7 or an 8, out of a 10. It could be because of concentration risk, which I discussed earlier. Maybe you've maxed out on the amount that you've been able to borrow with the credit union or financial institution. The dollars category, so which kind of falls in with the industry and NAICS category. We can only put so many dollars into the in specific categories. So like the industry, like a restaurant or something like that, we can only put so much out. Or there might be a lack of participants as well. Another no for now reason could be reputation risk. That falls under character. So, and SWOT risk as well. You see strengths, weaknesses, opportunities, and threats. Maybe when we run that analysis, it might not, there might be more threats and weaknesses as opposed to strengths or opportunities. And, we'll definitely be willing to work with you to get to where you need to be as well. There might be a collateral or appraisal shortage. So maybe the loan dollars exceed the amount of the appraised value of the property. So you may have to, get more capital to proceed with the loan and, come back and, we can get that yes. There might be some environmental issues, like a storage tank or something, below the ground that might have an issue to the environment in the future could be a no as well. So you may want to think of a different, property if you, in the event of like a commercial real estate deal. It could be the SBA is ineligible as well, which means you may have to change a little bit of your business, exactly what you're working with as well. And then it's important to understand the underwriting recommendations and what they need to do in the future. And I do want to mention underwriting is generally a little bit more conservative too on their matrix, because their goal is essentially to review and reduce risk and maintaining compliance and regulation. So I think that's really important. So even though we might give you a no, it doesn't mean that it's always going to be a no. It just might be for now. Just got to maybe put a little bit more capital in, maybe change the collateral or the loan dollars as well, and we can get to that yes. So actually that leads us to the end of part one, behind the lending curtain part two. And I just wanted to let you know about that one, which is the commitment funding reviews and renewals. That's going to be actually on September 9th. So it's about just under a month away. And I do want to mention that they my CEO, Dave Jazeski, will be hosting that one at that time. So if you guys have any, oh yeah.
Couple questions
Yeah,
out there, Liz. If the committee says no on for now, does that mean no from the SBA too?
That is a really good question. So not necessarily. And I do want to mention if the committee says no, and I just know this from our credit union, and each, financial institution does and reviews things differently. We do review all different parts. So SBA is not like a lender. They just help lenders to be able to lend more money out to borrowers. So generally, if the business committee says no, it's because we've already reviewed with the SBA option as well, and they most likely did not think that it should be approved.
Yeah, the bottom line is SBA does not lend.
Correct.
They stand behind the lender.
Yes, absolutely.
Right. Another question, this goes back to the earlier question on
Sure.
nonprofit. Um, what is responsibility for the loan when you deal with, who is responsible for the loan when you deal with a nonprofit?
Yeah, absolutely. So with a nonprofit, and I want to say the most recent one I worked with was actually a church. And so there wasn't necessarily anyone that, owns the church. There's the elders and everything like that. And there's signers to accounts and everything like that. And so there could be an option where there is no personal guarantee. On our end, it doesn't happen often. We do generally request, whether it be like a board member or someone that, is an authorized signer, to guarantee the loan as well, but it's not always necessary.
Well, the board of trustees or board of directors would have legal responsibility for anything incurred.
Correct. Yeah. Yes. That would have to be in writing as well. Yep. Correct.
Well, let me look. Is there one more here? Hold on.
Nope. You're good.
Wow. Okay. How does loan officer you consider the loan when doing cross-border trade outside the U.S.? I know there is the Export-Import Bank, but for
Okay.
startup with limited funds, how is that loan treated?
So actually, that is a really good question. I'm going to have to do a little bit more research on that one, if you don't mind, because we're a little bit more local. So a lot of what we do is actually just domestic in well, particularly in Ohio. So if I can get your information, that would be great, and I can follow up with
It's a
you
fellow
on
by
that.
the name of Glenn King. He can send you uh, more information. Uh,
Yep.
I
If you
do
could send me,
know what
that's
I
perfect.
would do. I would go to the SBDC in Cleveland State has a export import uh, office
Okay.
in Cleveland, and they have a couple people there that would be able to facilitate that.
Okay. Good to know. Thank you for that.
Okay. Oh, he's from this is a person from Florida, so that doesn't help. Well,
Okay.
you're good. He's going to have to uh, contact you with more detail and you get back.
Yes, please.
Okay.
That would be great.
All right. I think that's all of it.
Okay.
Well, thank you very much, Liz, and thank you all for attending the webinar. And with that, I will end the webinar, but please tune in on September 9th at
Yep.
noon. The presenter will be the CEO, Dave Chizewski, who is very entertaining and knowledgeable on the subject. Take care.
Thank you.